All right. Good morning, everyone. Good afternoon, wherever you are. Good evening. Apologies for the delay. As it's common with these type of events, technical issues, connection issues, audio issues, all types of issues. But here we are finally. We are delighted to have Dr. Claudio Soto from the Chilean Central Bank with us today. Just as a quick reference for him, he was appointed to the council in January 2024 for a 10-year period. Before that, he had an illustrious career in both the private and public sector, more recently as head of research and public policy at Banco Santander. So without further ado, most of you know the drill for these events. Dr. Soto will start with an opening remarks, and then after that, we'll open the floor for Q&A. If you want to ask a question, please you're going to have opportunity to raise your hand on Zoom, or you can send me an IB message on Bloomberg or via email. So Dr. Soto, thank you very much for joining, and the floor is yours.
Okay, thank you, Francisco. Thank you, the organizers. Let me just a quick disclaimer. We are in the process of building our new macro scenario that will be published and released in our next EPOM. So part of the story I'm going to tell now is based on our previous inflation report that was released in December last year. So we don't have an update yet on our macro forecast. That will be published by the end of March. So you have to wait a couple of weeks to have our new update for our macro forecast. I'm going to present our current macro forecast that was done, as I said, in December. So it doesn't really capture all the recent developments that we have seen in the global economy and also in the Chilean economy. Having said that, well, I'm open to discuss some issues that you might raise or that you might want to ask after the presentation. I have a few slides that I want to share with you that give you a hint on what we were seeing at the time back in December, which is the base for our macro scenario now. Okay, so let me share with you the presentation. Let me see if this is okay. So do you have it on your screen? Hold on.
Yeah, there you
go. Okay.
Yeah, we can see it.
Okay, great. So let me begin with the real economy. During 2003 and part of 2004, the economy went through this adjustment process that was needed after the overheating that we saw in 2021, 2022, after the pandemic, in response to the massive injection of liquidity by fiscal policy, monetary policy, the combination of fiscal monetary policy, and also pension fund withdrawals. The economy slowed down significantly in 2022, 2023, and part of 2024, we still saw this adjustment that was needed at the time. But at the beginning of 2024 and the second part of last year, the economy began recovering hand in hand with the change in the monetary policy position that began a couple of years ago when we began cutting rates. These are the figures that are coherent with the MASEC that was released a couple of months ago. In a couple of weeks, we are going to publish the revised figure for 2024, but the outlook is somehow similar to what we're seeing here, an economy that slowed down in 2022, 2023, and then it began growing back to trend in 2024. The slowdown of the economy created some slackness. The slackness needed to bring down inflation. You can see the output gap. The output gap was marginally negative during last year. Also, if you look at the labor market and you look at the unemployment rate vis-a-vis the NAIRU, you see also some slackness there that help containing inflationary pressures coming from the domestic markets. Inflation came down in a relatively rapid way until the beginning of last year. That was true for core inflation, but also the CPI came down very rapidly. We were almost at the target at the beginning of last year, but then in the second part of the year, we saw a rebound of inflation. Both the overall CPI inflation went up, but also some measures of core inflation came up. If you look at the decomposition between goods inflation and services, as in other parts of the world, we see services inflation coming down much slower than goods price inflation. And in the case of goods price inflation, after coming down rapidly in 2023, at the beginning of 2024, we saw this rebound in the last month of last year. There are a couple of important elements that explain this rebound in inflation, and those are mostly related to supply shocks. First of all, we saw an increase in real labor cost. I showed you a couple of slides ago that the labor market had some slackness, so the unemployment rate was above the NAIRU rate. Despite of that, we saw an increase in real labor cost, and this is more related to some regulatory changes that occur in the country. There was a reduction in the number of hours. The legal number of hours was cut down last year, and also there was an important increase in the minimum wage. Those elements combined to create some pressures on labor cost, and we saw an increase in labor cost in the second part of last year. And another element related to supply, a sort of supply shock, was this increase in electricity. During the pandemic, there was a freeze of electricity prices, and those prices were the freeze was ended last year. So there was a normalization of the electricity price with a very significant jump of electricity prices in the second part of last year until January this year. There were adjustments in the electricity price. Those are once for all increases in electricity. The adjustment has been done already. So what is coming now are the more normal functioning of the regulation in the case of electricity. Also, some external factor played a role here in terms of pushing up inflation, particularly in the case of goods price inflation. In the last part of last year, we saw an increase in the cost of shipping, for example. That has come down in recent months, but during the second part of last year, we saw an important increase in cost of shipping. And also we saw a depreciation of the currency. The peso went up in line with other currencies in the region, and that also created some pressures on prices that were reflected in this increase in the CPI until the end of last year. What we see in the margin, well, you are aware of this. The currency has been appreciating in recent weeks. In particular, this week, we saw also a very important appreciation of the peso. We have to see what happened later on, but there are some fundamentals explaining this appreciation of the currency, and we need to assess whether those fundamentals are persistent or is something transitory. This is part of the assessment that we are doing in our inflation report that is going to be released in a couple more weeks. Inflation expectations have moved up in this context, particularly last year, at the end of last year, break-even inflation went up. Hand in hand with the depreciation of the currency, we saw an increase in the break-evens there that coincide to a large extent with the depreciation of the peso. In recent weeks, with the appreciation of the peso, the break-evens have come down in a way, but have been oscillating. There are some noise here, but they didn't go up more, and they've been oscillating with a certain downward trend. And also, in the case of surveys, the surveys done to economists, the forecast for inflation on a 2 years horizon, which is our horizon, has remained well anchored at 3%. But surveys done to financial market agents have moved up a bit. There is more volatility in that survey. You can see there in history, there have been more oscillation around the target. So it went up. The last survey, it came down a bit, still above 3%, but at least we saw this break in the trend, upward trend that we saw in the couple of surveys done at the beginning of the year. Now, in terms of activity, I show you that after the slowdown needed to adjust inflation down, activity has gone up a bit during last year, approaching trend output. The adjustment in this case has been mostly led by the external sector of the economy. Domestic demand was relatively muted until recently. We saw an important adjustment in investment. Investment came down at the beginning of last year significantly. Then in the second part of the year, we saw a certain rebound in investment. And consumption also, after the boom of consumption that we saw in 2022, came down and has remained relatively flat in the last quarters. Here, we don't have the data for the last quarter of last year yet. It's going to be published in a couple of more weeks. But we expect down the road a recovery in domestic demand, in particular consumption. So what helped lifting growth last year was mostly the external sector, exports, and that was related to some extent to the real depreciation of the currency that we saw last year. So in that sense, the expenditure switching mechanism was working well last year. So part of the adjustment came through the exchange rate that helped lifting activity at least until the last part of last year. The fact that we saw this contraction in demand, in domestic demand, together with the improving term of trade, have helped an important recovery in external accounts. The current account deficit has come down. Again, the final figure for 2024 is going to be published in a couple of more weeks, but the trend is pretty clear. A current account deficit that was came from around 9% during the pandemic down to something around 2% or even below 2% in more recent data. So we have seen this very significant adjustment in external accounts. Now, in terms of the monetary policy, we began cutting rates already by the second part of 2023. Last year, we continued the cutting cycle of policy rate to end up last year with a policy rate at 5%. The cut in rates, policy rate, has been transmitted into market rates. We have seen a decline, an important decline in interest on loans, consumption loans, and commercial loans. Rates have come down. That has, of course, helped, lifting the economy in the margin, so that we remain with an activity that is close to trend, and that will help sustain the convergence of inflation after these supply shocks fade away. Now, in terms of the long part of the curve, here we have seen more volatility. The interest rate on bonds, term years bonds by the government, have been much more linked or correlated to what we have seen in external market. To some degree, the fact that the local capital market has less deepness has meant that the long rates have been more correlated with external rates. The less deepening of the capital market is to some extent related to the pension fund withdrawals. You can see there on the left-hand side, pension fund asset as a percentage point of GDP. There was a significant decline after pension fund withdrawals. We have seen a recovery in the margin, but still much less than what we saw previous to the pandemic or during the pandemic. And that has meant that issuances by companies, by the government, has been mostly abroad, and we have seen, therefore, a more correlation between long-term rates and external rates. Now, the outlook, as I explained at the beginning, this is the outlook of our last inflation report that was released in December. Our forecast for this year at the time was a growth between 1.5 and 2.5, with a recovery, mild recovery of domestic demand, and slowdown of the external sector after the strong growth of export last year, 5.6%, slowdown to 3.8%, and then next year also slowed down to 2.8%, and an economy growing, as I said, between 1.5 to 2.5, which is coherent with an economy growing at the trend rate that we estimate at around 2%, 1.9%, more precisely. So an economy that is running a trend. And with that, inflation, after going up until the middle of this year, will begin coming down by the end of this year, and then approaching the target already by the end of this year, the beginning of next year, and then oscillated around 3%. Why so? Well, first of all, the supply shock are going to fade away. So when you measure inflation year-over-year comparison, you will have a positive base effect that will help bring down inflation. And then, as I showed at the beginning, we still estimate there are some slackness in the economy, mild slackness, but some slackness that will contain more underlying pressures on inflation. Today, we got the number for February for CPI that was pretty much in line to what the market was expecting. Headline inflation a bit above core inflation at 0.3%. That is somehow coherent to this forecast that was done in December. If you look at the number for the first quarter of this year in our forecast at the time, is pretty much aligned with what we have seen for January and February now for the CPI. So the outlook is somehow of the previous inflation report is coherent to what we have seen in the figures up to now. And lastly, regarding the corridor for monetary policy, this is the scenario that we see for monetary policy coherent with the macro outlook that we presented at the time. And also the borders of the corridor reflect some sensitivity analysis that we do at the inflation report. Given that the monetary policy at 5% is much closer to the range of values that we consider to be neutral for the monetary policy, the movement down the road were much more muted in this corridor analysis than what we saw when we began the cutting cycle. So moving much more muted down the road and approaching smoothly the range of values coherent with the neutral rate. Now, in terms of the market expectation for monetary policy, that has been much more correlated to what the market perceive is the strategy of the Fed, the policy rate in the US. You can see there have been a large correlation between the 2-year implied monetary rate in Chile with respect to what is the monetary policy, the 2 years implied rate for the US. The ups and downs we've seen recently in recent weeks somehow reflect this view that there is a correlation between our policy rate and the policy rate in the US. But up to now, we have been very independent in defining our policy rate. And the fact is that we're much closer to our neutral rate. Therefore, next movement of the policy rate will be conditional on that. Okay, so that is more or less the outlook, the slides that I want to present to you, and now I'm open to the Q&A.
Many thanks, Dr. Soto. So if someone wants to raise a question, please raise your hand. We'll unmute you, but so we'll give a couple minutes for people to line up. In the meantime, I'm gonna turn it over to our FX strategist, Carlos Munoz, to pose the first question. Please go ahead, Carlos.
Thank you, Francisco, and thank you very much, Mr. Soto, for the very comprehensive presentation. I want to bring you back to the monetary policy stance. I was rereading the minutes from the December meeting and then from the January meeting, and there's been a shift. In December, there was a consensus that the board would continue cutting rates, whereas in January, there is some, I don't know if disagreement, but some people raised the possibility of hiking rates in the future. And I want to know your opinion on that. Do you think the risks to the ongoing pause are tilted towards a hike or a cut?
Yeah, well, I cannot give you a risk scenario right now. I can somehow try to explain to you what is behind the communication we did at the monetary policy in January. So basically, at that moment, what we saw was further depreciation of the currency, which was not in line with our baseline scenario at the time. In the inflation report, our baseline scenario was coherent with an appreciation of the currency rather than a depreciation of the currency. So for the last monetary policy, we had a surprise on the FX. Also, we saw an important increase in inflation expectation in different measures, surveys, the break-evens. So there was that was a novelty at the time. So the statement we did at the time was, well, monetary policy has to take into account that, and our monetary policy strategy will be such that we guarantee that inflation will converge within the horizon, the 2 years horizon. Okay, so that was pretty much what was behind the communication. So we were seeing some risk, upward risk on inflation coming from, first of all, the exchange rate, but also the possibility that if inflation expectations remain above target for some time, that could risk of having second round effects feeding into inflation, and therefore we take that into account, and that explains pretty much the communication we did at that monetary policy meeting.
Thank you. And quick follow-up question. In terms of inflation expectations, do you which measures do you follow more closely or weigh more on your decision-making process? Market indicators or the surveys that the central bank conducts? Any color on that?
It's a combination because break-evens are noisy, and there are some market effect that might pollute that measure depending on the liquidity of the market. So we are aware of that. Then we have surveys done to economists that probably their analysis based more on an analytical framework. Then we do surveys to financial market operations that are trading based on their forecast. So there is, money at risk there. So there are different angles, and we take all of them into account to assess what is the expectation of the society as a whole.
Great, thank you.
Excellent. So let's move on to Paulo Mateus. Please go ahead.
Thank you, Francisco. Thank you very much, Deputy Governor. I have two questions, actually. One was on the latest data on consumption. We saw really very strong data on retail sales in January. And that most analysts seem to have explained that away as the impact from Argentinian tourists coming in. Indeed, there was a huge inflow of tourists in December and especially January. There are two ways to read this, right? One is that maybe Chilean consumers are not that strong, but you have these tourists coming in. So maybe true domestic demand is not as strong as it seems. But the other way to look at it is that Argentinian tourists are competing with domestic consumers anyway, so that will raise prices anyway, right? No matter if the domestic consumer is not as strong. So first is whether you agree with this interpretation that there was a big boost to consumption data because of the tourists or not. And second, whether this surprised you and we should be worried about potential price pressures coming from that, as long as real exchange rate in Argentina stays as strong as it is. And my second question is on the labor cost that you pointed out. So wage growth remains very high. Just the last data is still above 7%. Remember the last time we spoke with BCCH and the governor was there at the IMF in October and pointed out the increasing minimum wages that was pushing total wages, average wages up. But if you looked at quantities, it looked like the labor market was soft. So BCCH was expecting wage pressures to be more transitory. After all these months, what would you say is your take on the evolution of that? Are you surprised to see still wage growth as strong as we see? Or is this consistent with what you were expecting already and there hasn't been much of a surprise there? Thank you.
Okay. Yeah, well, as I show in my presentation, the boost that we saw in activity, the mild boost that we saw in activity in the second part of last year came mainly from the external sector, export. In the case of export, you have to take into account goods export, but also services. In the case of tourism, that is the case. We have seen an important increase in tourism coming from Argentina, but also other countries. And that is related to this, adjustment coming from the external sector rather than domestic demand. So part of the adjustment that you would expect when you start cutting rates, there is a delay that impacts domestic demand, and there is a more direct impact on the currency, on the real exchange rate, and that also has an impact on the external sector. In terms of measuring inflationary pressures, we take into account the output gap, and the output gap is based on activity, real activity, the GDP. So no matter whether it comes from domestic demand or external demand, what matters here is the output gap, and the output gap would be affected either by domestic consumption or external consumption. So that is what we take into account, and this is embedded in our macro scenario. So in terms of the retail sales, yeah, probably related mostly to having tourism having an impact on retail sales. Now our figure for commerce that we publish that is in the IMASEC, that is commerce includes wholesale commerce and retail sales. And in the case of wholesale, we have seen also an impact coming from the export, the boom that we saw in export, that also is reflected in that line. So again, related to the external sector having a good period as a reflection of this adjustment that it's coming from the real depreciation of the currency, plus some other specific factors that have been having an impact on export. Now, in terms of the labor market, yeah, most of the impact, supply side impact, we expect to be one-offs. It could be a sequence of one-offs, but they are one-off. In the end, what is more persistent or could be more persistent would be the case in the case that we see an unemployment rate falling substantially below the equilibrium rate or employment growing very fast, that would create the condition for cost pressure persistent over time, having an impact on inflation. Up to now, what we have seen mostly are one-offs, could be a sequence of one-off, but at the end of the day are one-off, have been reflecting in wages, and that had an impact on inflation last year that was captured in our forecast, and it's part of what we see as the forecast for this year.
Thank you.
Thank you. Tiago Severo, you're next. Please go ahead.
Thank you, Francisco. Thank you, Claudio. I have a sort of like a follow-up question on Paulo's and Carlos's initial question. Since this change in communication in January, the data that you have seen so far, there are a number of indicators that point to a more favorable outlook for inflation in the short term. The FX is one of them. Obviously, global energy prices have moved in the right direction as well. Plus, with today's CPI, I think we have increasing evidence that the second round effects of the energy tariff adjustment are limited. But the quantities have started to improve. I mean, we saw activity picking up. We saw for the first time recently a labor market data improving in terms of like employment creation as well. So how do you assess the evolution of the data since January vis-a-vis this more hawkish communication? And then the second question is, you mentioned on one of your slides that monetary policy has been transmitted to market rates, particularly short-term lending rates, but credit volumes have been pre-muted so far. So to what do you attribute that, and do you expect some pickup in credit markets going forward?
Okay. Well, yeah, I cannot go too much in deep on the assessment of the last few years, because that is part of our discussion for the monetary policy report. The only thing I can tell you is that a key element for our analysis is to assess whether what we see in the margin is persistent enough in order to change our outlook for the medium term. Okay, so in the case of the currency, for example, we have seen an appreciation, but we really need to assess whether that is persistent or not, whether the fundamentals behind that can remain over time, or this is just noise that will be reversed. That is the key element of our analysis, and we have to assess that in the context of our inflation report. Also, what you mentioned, the figures on activity, we need to assess whether this is something transitory related to, very specific exports, or this is something more persistent over time that will change the outlook for inflation. Those are the key elements of analysis that we're going to publish in a couple more weeks with our inflation report. The evolution of credit has been affected for the legacy of what we saw in the pandemic, in particular in the case of consumption credit. We saw a boom in consumption during the pandemic, household access to very strong liquidity due to the pension fund withdrawals. There was a very big boom in durable consumption. And then what we've seen up to now is an adjustment on consumption, in particular in the case of durable goods. Probably we're in the end of we're seeing the last part of this adjustment, and then we should see a change in tendency. In the case of commercial loans, when you look at the sectorial loans, it's pretty clear that there are some sectors that have been dragging loans. The recovery has not been even across sectors in the economy. It is clear that the construction sector, for example, is lagging behind, and that explains to a large extent what we see in credit. So, but this is again part of the macro adjustment. Now, when you see data on flows, on loans flows, not the stock, but flows, we have seen a pickup already at the end of last year. So that should point towards a recovery down the road in stocks. There are some also valuation effects, but at least in the margin, what we see in terms of flows, it's a pickup in flows. that should mark, the tendency in stock during this year.
Thank you. Juan Pablo Solórzano, please go ahead.
Thank you so much. Really appreciate your time. Can I just compliment Paulo's and Tiago's questions on activity? If you can touch on the investment front. I want to understand what are you thinking about copper more specifically, the price increase, but also kind of the broader outlook. We got the release of the business survey, which includes like a decomposition on the mining sector, and it seems like it even looks like it's a fat finger, like the outlook for demand. Looks like it is improving exponentially. And if you can lastly just think about how does a change in mining or copper impact the outlook, the non-mining GDP, the spillovers, how does that channel work?
Okay. Well, we have seen, an increase in copper prices. We see a very significant discrepancy this time around between the LME price and COMEX price in the market in the US. There is a discussion here whether that reflects all the discussion about tariffs, but overall we see an important rebound in the copper price. Now, in terms of activity or in terms of investment, mining investment has lowered throughout the rest of the economy, and mining investment is guided mostly on an assessment on the long-term price of copper. Last year, we revised upward our view on the long-term price of copper, and we have remained with a price that is between 4.5% dollars per pound, and we haven't changed much our view, that we have sustained that view. And also, I think the market has also came to the conclusion that the long-term price of copper is around that figure. That has helped, limiting the tail risk for the price, and that also has helped, to have a more positive view in terms of investment that has been reflected on investment that we have seen already, but also the outlook for investment in the case of the copper price. Now, what is relevant for the macro cycle or the macro outlook and the impact on other sectors of the economy that could create inflationary pressures is more related to the long-term price of copper, and that, according to our view, has not changed much. We have to see now for the next inflation report whether we revise or not that number. But at least during last year, we didn't revise much that number. So in terms of the impact of copper on the rest of the economy, we didn't change much our view during the last year.
Thank you. Joao Ribeiro.
Thank you very much, Francisco. Thank you, Deputy Governor. I appreciate that you can't comment much on the data that's come out since the beginning of the year, since your last communication. I would ask, though, for you to please tell us your framework on how to think about Chile in the context of this possible global trade war. In particular, how do you trust, for lack of a better word, the appreciation of the peso so far this year, given so much uncertainty, added the wrinkle of activity picking up, no? So how and when would you feel more comfortable with the currency, given that there's just so much uncertainty on the horizon and your activity seems to be doing fine? Thank you very much.
Yeah, well, it's a tough question, and that is precisely what we're in the middle of our assessment here. To some extent, the appreciation of the currency reflects the weakness of the dollar more globally. It's hard to comment on that. whether that is going to be persist or not. We will have to take a stance on that probably during our discussion for the inflation report. The other element is the copper price. As I was commenting before, there have been an important increase in the copper price. And again, we haven't changed much, at least during the last year, we didn't change much our view for the long-term price of copper. Probably we don't have too many elements now to rephrase that. So we have to, revise our view on that. But I can tell you that we didn't change much last year. And so we have to see up to what extent what we have seen now in the copper market, and in particular in the case of the COMEX copper price, where that will converge to something more similar to what we've seen in the London market, or there will remain a gap there, and with the impact on the windfalls for the Chilean economy. We export an important amount of copper to the US, and the price at which it sells is more related to the COMEX price rather than the LME. So we have to see that. We're precisely looking more carefully. But it's hard to see whether that would be something more persistent or not. But we recognize that the exchange rate also is a noisy variable. When we have seen a depreciation of the currency, a rapid depreciation of the currency, we haven't changed one our view on the evolution of the currency necessarily. Same might be true when we see a very rapid depreciation. So we recognize that there is a volatility there, and we try to eliminate the noise and try to get what is more fundamental.
Thank you very much.
Thank you. Anyone, Ruka, please go ahead.
Hi, many thanks for your time and for taking my question. I would like to hear views, your personal opinion, and what do you think would be more important in terms of assessing the external impulse for the Chilean economy, given this high uncertain scenario, and as you mentioned, this well-behaved copper price, the long-term copper price. So I'd like to hear your view on what do you think it's more important in terms of assessing the net effect of this external impulse, given this high uncertainty and the well-behaved copper price?
Well, we have several elements here. On the one hand, we have data. The data we got for the beginning of the year or the end of last year for China, for example, was better than what was expecting the market in general. So we saw data, actual data that was on the upside. So that's part of the new outlook that we have to take into account. Then we have, the outlook for the external sector of the economy, copper in particular, but also we have seen very dynamic exports, more broadly speaking. Some of that is supply side positive shocks that might fade away, but there are some other elements that might be more persistent. But at the same time, we are in an environment of high uncertainty that is pretty clear, and we know that uncertainty has an impact on investment decisions, on expenditure decision, more broadly speaking. So there are counterbalancing effects here, and we're in the middle, as I said, of the preparation of the inflation report, and we have to, balance those things to have an final outlook for what is the most likely scenario in terms of external impulse for the Chilean economy. So forces are not pointing all in the same direction. There are forces pointing in one direction, forces pointing in another direction, and we have to, make the synthesis here.
Mateus Ravelo, please go ahead.
Hi, thanks for taking my question. Actually, I have two quick ones. First, how do you assess the possibility of a positive output gap given the recent evolution of activity data? The second, you mentioned interest rates are close to the neutral range. Given that, what would you say that needs to happen to cut rates again? Thanks.
Okay. So in terms of the output gap, I showed you in the slide that what our assessment until December last year was that there was a negative output gap, but was not too large, so relatively small negative output gap. There is some noise in terms of the level of activity when you take into consideration the seasonal adjustment. Still, there is some noise. So we might have some noise with a positive shock on activity at the beginning of the year. Probably, if you look at the IMACEC that we got up to now, that might shift around a bit the output gap. But we have to assess what is more persistent throughout the year, and for that we need our forecast. We need to know up to what extent the positive figures that we got for activity at the end of last year, at the beginning of this year, whether those figures remain or not. And therefore, we might have some volatility in terms of the output gap, but the assessment in terms of the impact on inflation on a medium-term horizon requires the outlook for activity for this year and next year. Now, in terms of the monetary strategy, our strategy is based on our target, our compromise of bringing down inflation to 3% on a 2 years horizon. The fact that the monetary policy is above the neutral rate means that the monetary policy is still in a contractionary fashion, although we're pretty close to the neutral range. So if probably the monetary policy at this moment is not, pushing too much down the economy or too much up, it's close to neutral in that sense. And the strategy for the next move will be pretty much dependent on the outlook for inflation and what is needed to bring down inflation back to 3%. So this is more.
Omerman, go ahead.
Thank you very much for taking the time to answer questions. I would like actually to go and throw us back about 9 months, where you had June IPOM, which was probably the most hawkish IPOM that was released by the central bank in quite some time, that really threw the market off. Looking at the analysis that you have done on inflation there, we are still seeing inflation lower than what was assessed in that IPOM. All current externalities, I would call it, and the story development in Chile is playing in much better scenarios than what was expected in the June IPOM. In line with December, we are 3 months in, about a couple of weeks away from the next IPOM. And from what I synthesize from what you have said so far, that everything is playing in the same direction. From September, December, I guess January's minutes were kind of a one-off to a one-off scenario. And most of the attention that you're paying to right now is with CLP. In the past, the central bank has said they're not concerned so much about CLP levels. Market is aware that above 1,000, this is a threshold that the central bank might mention that. We're very far from that. What in the scenario has changed or can change in terms of inflation in the long run in Chile especially that we know that also Chile didn't meet its deficit fiscal spending targets, and we know that we're going to, I'm sorry for the lengthy question, but it's centralizes kind of like the main picture. We're going into election year, fiscal spending supposed to come down, and in the long run, we're seeing, and also from your language, you're willing to see inflation running at around 5%. What is the main concern here that can really throw things off in Chile, in the Central Bank opinion? Because we are 70 pesos away from anywhere near CLP being a concern again.
Well, there are some statements in your question that I do not necessarily share, but let me go to your question. So I think there are many things happening, in particular the last 2 weeks, right? We have seen a lot of volatility in markets. Also gotten figures for Chile, activity and inflation today. And I think there are some elements that probably could help inflation come down, the oil price, what we have seen with the currency in recent weeks. But also there are some elements that could push inflation up. There is still an important pressure coming from labor cost, despite the fact that I think there are some one-offs explained to a large extent that, but also have an impact on inflation, and there are some persistency embedded in the inflation dynamics. And also activity, in the case that we revise our output gap, that could change also the outlook for inflation coming from local activity. So I think it's not clear what is the final outcome in terms of the inflation outlook, and therefore for the monetary policy strategy coherent with bringing down inflation to target. Now, let me be very clear on this. It's true that inflation is above target. It went up almost up to 5% in January. Now it came down a bit. But we knew that was going to happen. We explained that to the market carefully. There was a very important shock coming from the normalization of electricity prices. That is a supply shock. That is a one-off that pushes up inflation for a while, but then automatically it should bring inflation down once you remove that from the base comparison for the CPI. That will happen during this year and at the beginning of next year. So that's why the forecast has this hump, very clear hump, and we think that this is still the case. No, the inflation has not surprised in the last couple of months. The market was pretty much aligned to what we saw in terms of inflation, and that reflects that we were able to explain carefully what was the cause of the hike of inflation at the end of last year, and that will have inflation to be above target for a while, but then should help bringing down inflation down to target by the end of this year or next year. Of course, there are risks, and those are precisely what the elements that we are analyzing in our inflation report. We have to balance carefully the risk that we are seeing, and also elements that will change our baseline scenario.
All right. I think that we can call it a day. We are very thankful to Dr. Soto and to all our clients that joined this call. Thank you very much to you all, and well, have a good weekend, everyone. See you next time. Bye.